Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage that was identifying winning stocks with massive upside. Like Riot Blockchain before it shot up 10,090%, Digital Turbine before it shot up 789%, Overstock.com before it shot up 1,050%. This power gauge comes from the legendary Mark Chaikin. Right now, you can get a free in-depth look at how his power gauge system works. A way to type in any of 4,000 different tickers and see exactly where the stock is most likely to go next and in any type of market. Simply go to powergaugepreview.com for a free look. Again, that's powergaugepreview.com. Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's Thursday, May 26, 2022. We're having a bit of a market rally, for maybe a two-day rally. Could we break the 7-week losing streak and what that means if we do? That and 3 materials that are changing the world right now, that are in high demand and are ways to play the booming, roaring 2020s. We're gonna talk about them and stocks that are related to that. All that and much more coming up right now on Making Money. Again, welcome. This is Matt McCall. Thanks for joining me here. This is Making Money. It is the 26th of May, 2022. A beautiful Thursday morning here in South Florida, looking out the sun shining into the one little window in the corner over there. So thank you so much for joining me. We're actually having a bit of a rally. I don't know what to do anymore when we could potentially have a week, folks, that's actually up. Believe it or not, we could have an up week. We've had 7 consecutive down weeks. That doesn't happen very often. I'm going to talk about that in a moment. I'm going to show you some charts about what that means. But let's get right into this. Let's look at the S&P 500 right now. And again, we're only about an hour into trading here on Thursday morning, but the S&P, tracked by the SPYs here, the SPY, the ETF, is up about 1.6%. And you can see from the low that we had last week, that intraday low, I'm going to give you the gain that we have from there, and you're going to be probably a little bit blown away. We're up about nearly 6% from that low. And again, it doesn't feel like that because a lot of portfolios are still well down, and we're still way down from where we were going back to the first trading day of January of this year. But as you can see, we are having a bit of a bounce back. Listen, folks, this could easily be just a snapback rally, what I call a dead cat bounce. I'm not claiming to bottom, but I've been saying for a while now, I'm not going to try and pick the bottom. I'm going to look for a sweet spot. And I've said that if we break 4,000 on the S&P, which we did, we came down to about 3,800, that we could see 34 to 3,600. So I'll call it 35 in the middle. I still think that's possible. I hope it doesn't happen. But part of me says if it does, we're going to have some great buying opportunities. If we don't, though, I think maybe if we see a follow through into next week, there's at some point you want to start dribbling a little bit of money back in, because if we don't pull back there, you want to try to pick up some shares that are beaten down right here. And a lot of the beaten down shares are starting to move higher. Could some individual stocks have made a bottom? I think that's definitely realistic to say that. I think there definitely are some stocks out there that we've seen the bottom in, that were down 70, 80% from highs, where that pendulum I talk about every show swung so far to the overbought, but swung so far to the other side to oversold that eventually buying comes in, rational investors see long-term opportunity, and they start buying. So I think we've seen that in some positions, especially some of the innovation and growth stocks in the last week or two, potential bottoms in for that. But the rally, just to give you an idea, the Fed minutes came out yesterday afternoon. The market was already up prior to that, but it rallied more. Overnight, I checked the futures in the middle of the night. Of course, I don't sleep very well, as you know, and the futures were down. Then this morning, futures were up, and we've seen a rally through the first hour. So when I look at the market here, I'm a bit torn, to be honest with you, because we're seeing the Fed minutes come out, and we know the Fed is going to be somewhat aggressive, all right? We know that. So that a lot of that's priced in. So when you look at that, it's not as surprising. All that being said, though, the Fed at the same time, if they see the market or they see the economy slowing down, they do have the option of potentially saying, you know what, we're not going to be as aggressive when we're raising rates. So again, I've said a lot of times in the past that I think a lot of this stuff has been priced in. And by being priced in, you start thinking to yourself, well, if it's been priced in and the Fed deviates from the hawkishness that we think, we could see a big relief rally. So I think the downside potential is maybe 10% from here, but the upside potential is 30, 40% next 12 months. So you got a 3 or 4 to 1 reward to risk, which is a great ratio in any market. So that's how I'm looking at it now. So yesterday marked day 100 for trading. And I'm going to show you a few charts here that show the really underperformance of the market. So let's go to the first one here. This shows the S&P 500 first 100 trading day performance since 1953. And the reason it shows that is because in 1952, we started going to a trading week that was 5 days long. Prior to that, it was not. So let's go to the 5-day week. And you can see here, down 17.3% after 100 trading days. Only 1 year prior, going back to 1970, was worse than that. So this is a very ugly start to the year, folks. And again, I've talked about this with you many, many times about if it feels to you like this is tough, well, it is tough. It really is. So it's not abnormal for you to feel that way. So I'm going to pull up another chart here, and this is pretty interesting. This shows the S&P 500 performance after losing over 15% in 100 trading days. This is not the first 100 trading days. This is rolling 100 trading days, again, going back to 1953. And as you can see here, the performance, and we're down 17.3, so we fall into this category. The performance 1 week, 1 month, 3 months, 6 months, 1 year. And again, let's look at 1 year because that's really all that matters. We're not traders. We're looking long term. The odds of it being higher in that time frame, if you go back since 1953, 69%, and the median return of 19.4. But if you take all periods, not just these periods, you got a gain of 10.9 or it's 10.2. So you're almost double after this happens. So again, this is setting up historically for a potential rally because when we have such underperformance, and the other thing to keep in mind is we have only had this happen 16 times in the past since 1952, where we have a rolling 100-day return down at least 15%. Only 16 other times in the last 70 years. And again, it shows right here that we have pretty good darn returns after that happens. Let me show you kind of what that looks like on this chart. And this is exactly what I was talking about, going back to 1952. This is only the few times that it's been down any 100 rolling days. It doesn't happen very often. Again, this is a 70-year time frame, and you can see right here where we broke below that, down 17.3. So we've had other times that it's happened. It's not like it's never happened before. But again, 16 times, now the 17th time in 70 years. So it doesn't happen very often. So look at the small caps potentially, right? Look at this, folks. This is the Russell 2000 performance after a week first 100 days. And you can see here the Russell 2000, it only goes back to 1979 when this index was put together. But you look at 2022, it's the worst first 100 days ever. Worst ever, by far, by about 5%, 4.9%. But let's look back. In all the prior times, it was up 90% of the time. 9 out of 10 times it was up 1 year later. You can see the median gain 8.2, average 12.9. But you take away really 2008, it's been really some very nice returns 1 year later. And again, much better than what you would see average of all periods since 1979. And again, up 90% of the time. So again, we try to put the odds in our favor. And I talk about that a lot, just kind of looking at the odds. And one more chart I want to show you. I just said this. We had a 7-week losing streak coming into this week. And during that time, that 7-week time frame, we've had the S&P down 14%. So one more chart I want to show you here. This is going back to 1928. And you can see we've only been down 8 two times. This would tie the record. If we follow through, it's Thursday, we're well on pace to break the streak. So if it ends here at 7, again, just look out, folks, what the returns are like 1 year later. They're not blockbuster, up 5.8, but 3 years, 31, 5, 52, and then 10-year, 176. And again, I hate to say think about 10 years ahead because people can't think of 10 days ahead, let alone 10 years. But most people, even though you may not feel this way, depending on your age, that you're going to live 10 years plus, you're most likely to make a heck ton of money in the next 10 years in the market. And this is just the S&P 500. What that chart shows you, though, is typically when we have down like this, in the near term, it can have some more short-term weakness. That is very true. But you take away some of the years in there that are basically around the Great Depression and the tech bubble, you really take those two out and you start really turning around 9 months to 1 year later. We start having some decent returns. So again, it's very tough to call a bottom. It's very tough to live through this type of downturn. But you have to think big picture. You have to think about the fact that innovation is going to continue. One of the hardest things to do is sit through a bear market, is sit through a recession, to sit through times in business when you're not having the best year. I've owned businesses now for 18 years, and not every year was good. Sometimes you have 3 great years in a row, then business plummets for 2 years. You start thinking, well, maybe this business is dead. Maybe I should get into a different industry. I've been through it all. You think the same way with the stock market. That thinking typically does not pan out very well because it's emotional. It's driven by emotions. It's emotional thinking. When you start making emotional decisions, let's think about something that's more of a realistic topic. Say you're in a fight with your wife or husband, girlfriend, boyfriend, best friend, and they say something and you hastily text something back. And then an hour later, you're like, oh, what the hell did I do? Like, I should have taken a deep breath, went for a walk, thrown the phone away for an hour, then got my thoughts together and made a rational response. Might be your boss who says something to you and you fire it right back. Oh, geez, you probably shouldn't have said that. Take a deep breath, walk away for an hour, come back. Same thing with the stock market. We tend to overreact and be rational, sell when we shouldn't, buy when we shouldn't, where in reality, we should probably just take a walk and get away for a little bit. So that's what you should be doing now, in my opinion, taking that nice little walk. Even though things are coming back today, maybe you want to revel in the fact that stocks are potentially going to be up for 2 days here and breaking a 7-week losing streak. So maybe we want to revel in that for just a little bit while we have it. So now, folks, I want to talk about 3 elements, minerals, materials, whatever you want to call them, that are all basically tied to some mega trends that are going on right now. And the first one is lithium. And we all know lithium's demand is basically driven by lithium-ion batteries that are in everything from this little switcher I got next to me to the phone, to the computer, to the camera, to everything's got lithium-ion batteries in them. And that's all fine and dandy, these little batteries, but we know the real demand is coming from much larger batteries that go into electric vehicles. We all basically know that the demand for electric vehicles is only going to continue. We don't see that falling anytime soon. As that demand continues, so will the demand for lithium that goes into the batteries that are needed to drive lithium-ion batteries. So let me show you a chart here, folks. This comes from Bloomberg NEF. And this shows the global electric vehicle sales. You can see this goes back to 2013 and 2021. Just basically from 0 up to about 2.4 million units. And then you look at lithium price. Why do you think the lithium price is shot up like that? Well, there's a lot of underdevelopment going on back here because the price wasn't really moving too much. And then, of course, demand. Price moves at the end of the day based on what? Supply and demand. And when supply does not keep up with demand, prices will increase. I talk about this a lot with Bitcoin and other assets. So I'm going to show you one last chart here. And this one's from Benchmark Mineral Intelligence. As you can see, it says the industry needs as much as $42 billion of investments to meet demand by the end of the roaring 2020s. And this shows the market imbalance. The black is demand and the gray is the mine supply of lithium. And from 2022 all the way through the end of the decade, the demand will outstrip the mined supply. So when I see that, simple economics 101, I probably had it in high school. When demand is more than supply, you got to come into equilibrium, and that means the price has to go up and the vice versa. So I see it continuing. And to me, lithium has been a sector that I've talked about a lot over the last 10 years. And I got to tell you, folks, I don't see it ending anytime soon. I'm a major proponent of new battery technologies, whether it be solid state battery, whether it be using silicon. There's so many different ways that we can have this go. I think solid state will win out eventually. There's just news out this week that General Motors and Honda, they're working on solid state battery for EVs. It won't likely be commercial till 2025, 2026. But they're working on it, along with Toyota and Volkswagen and basically any other company out there is working on it because they realize the battery endurance, the battery storage, the battery life, the duration that it lasts, how far you can drive on it, all increases dramatically, and they're much safer because you don't have the liquid in the middle. Liquid in the middle of lithium-ion batteries is what becomes very dangerous. You also get rid of cobalt, which I'll talk about in a minute, and over half cobalt comes from the DRC, the Democratic Republic of Congo, which is one of the most unstable countries in the world. Child labor, horrible things. So people are trying to move away from cobalt, which again goes into lithium-ion, which I think will push more for solid-state batteries. And it's the third lightest element, believe it or not, behind hydrogen and helium. And it was discovered in 1817 by Swedish chemist Johann August Arfwedson. They have great names over there in Sweden. But it really wasn't produced in higher quantity until the U.S. government started stockpiling it back in the late 1950s for, guess what, hydrogen bombs. But then after the Cold War, production went back down again, and then it kind of boosted back up when mobile phones really came out in 1990s because for all lithium-ion battery demand. So there's quite a few ways to play this. China is really still the leader. Over half of the global supply, though, comes from what they call the lithium triangle: Bolivia, Chile, and Argentina. But China is a major player. They take on a lot of that supply because they're the largest producer of lithium-ion batteries by far in the world, by far. They just basically have the corner of that market, and they have a corner of a lot of these markets. But there's a couple companies I want to show you, and again, nothing here is a buy or sell recommendation by any means. Sharing information, educating you on the couple companies here that I think you should probably want to put on your radar. And the first one I'm going to pull up here is it's an Australian company. Australia is big into lithium mining. So let's take a look at this. And this is PILBF Minerals. So it trades here over the counter because it's an Australian company. So the symbol is PILBF. That's why there are 5 symbols. So PILBF Minerals, as you can see here, not a bad looking chart. I mean, it looks much better than a lot of stocks out there. If I zoom out and show you the long-term chart, this was down around less than 10 cents a share. It's at $2 now. And that's just from a 2020. So that's over a 20 bagger from that low. It was up about a 28 bagger at one point. This is a bigger company, even though you see the $2 price tag on it. It is a bigger company. But what I like about that, they have a mine in Western Australia, and they have a big project that's going on right now. And they're working with 2 Chinese companies, CATL, which is the world's largest battery producer, and Great Wall Motor Company, which is a large EV auto company in China as well. So they got 2 pretty big partners. And again, China will pay a lot for this. There's big demand from China. And they came out earlier this year, and they're aiming to raise production by more than 50% by the third quarter, which is huge. I mean, that's a big increase. And if that happens, obviously, with prices very high in lithium right now, would really kind of roll over and be really well for that company. So the world's largest lithium producer is actually based out of here in the United States, Charlotte, North Carolina. And this is Albemarle. I always mispronounce this, so don't bash me. I can't pronounce this name at all. You can see very similar chart actually to PILBF that I just showed you. If it closes here, it's going to be closing at the best close in a couple months. But again, let's look at a long-term chart. At that low is below 50, and now we're up to let's call it 250, so about a 5xer from that low. But we were off the highs. We're up to 290, late last year. But this is, again, this is a bigger company. It's one that has been around a long time, but it is the world's largest lithium producer. And what people don't talk about is they want the lithium for the batteries for EVs to make the world greener. The thing is, they use a lot of water, especially in Chile and down in the lithium triangle down there in Bolivia and Argentina, because those salt flats down there are very, very dry, one of the driest places in the world. So they need a lot of water. So it's actually not the greatest thing for the environment. But the ALB has come out and said they're trying to reduce the use of fresh water by a quarter, by 25% by 2030, where there's a high water risk. I mean, it doesn't sound like a lot, but at least they're trying a little bit to do that. And there's one more I want to show you. And this stock, it's trades here over the counter as well. And this is called Allchem. And this was created by a merger of Ocabro Libre, not Ocabre, something like that. Anyway, and Galaxy. So now it's, I think, the 5th largest lithium producer in the world. That's why it still has a symbol OROCF. That's its old symbol. But again, very similar chart that we've seen in the last couple lithium. If I zoom out here again, look at this low. Below $1, and now we're up to 965. So, about a 10xer that we've seen on this since the low in 2020. But again, if demand continues like I think, you'll see a lot of these stocks continue. And one last chart I want to show you here. It's just the price of lithium. So you can see right here, folks, this is the lithium futures, the current contract that we're looking at right now. And you can see back in June, it was around 17 or so. That's June of last year, obviously. And now we're sitting around 80. Kind of consolidating here a bit, but I don't see this trend ending anytime soon, folks. So lithium is, again, there's a lot of lithium stocks out there. There's a lot that I've recommended to my subscribers. But again, just sharing this with you. And I think it's something that you really kind of want to put on your radar, because I think you can't ignore right now what's going on. The next element I want to talk about is the second latest element. Of course, we said lithium was 3, hydrogen is number 1. This is helium. And the reason I've been reading about helium, believe it or not, that's how nerdy I am. I've been reading about helium because the demand continues to increase for it. The number 1 use of helium is in MRI machines, but it's also used in disk drives and quantum computing. You're seeing big demand there. It's used in aerospace defense. It's used in a lot of trends that are booming right now, a lot of innovative trends. But it came to my attention again this week when the University of Nebraska announced that their football team will not be releasing red balloons at the first touchdown at its first home game. And normally they would do that, and there's 80,000 red balloons going up, and it looks super cool. And they've been trying to actually stop it for a while because people think that when it lands, it hurts people or something, or it is litter, so I will give you that. Or kids eat it, which I think kids eat a lot of weird stuff, but I don't think that odds of them eating a red balloon. Anyway, they've been trying to stop it. 80-year tradition. This has been going on. Looks super cool. I'm not a Nebraska fan, so I really don't care. But so the U.S. right now, they're the leader supplier of helium. And the 2 biggest behind them are Qatar and Algeria. The problem is with Qatar and Algeria, they're not the most stable countries in the world. And so Russia was trying to get into the helium business. They opened a helium factory late last year. They had 2 fires in it, so they kept shutting it down. And they haven't been able to fix it because of war in Ukraine. Nobody's supplying them with what they need to fix it, and their economy's in shambles. So you're not seeing more come on right there. The demand for helium right now is around 32,000 tons per year. That's about 10 times the amount that the Earth produces naturally. So there's obviously a supply-demand issue. The other thing is the U.S. government has the only helium storage facility in the world, and it's expected to close it up by the end of the year. This was a decision that was made like 6 years ago. So a supply-demand issue, again, folks. There's a couple companies out there. There's 3 big gas companies. I deal with a lot of these gases. Helium just happens to be one of them. And I'll go through these 3 real quick. One I've talked about not too long ago. This is Air Products, APD, based in Allentown, Pennsylvania, right across the street from where I was born in Bethlehem, Pennsylvania. So I like Air Products for a lot of different reasons. And another one is Linde, LIN. This is a European company. So you can see here, it's had a pretty decent chart, really, holding up much better than a lot of things out there. And the third one is Air Liquide, which again, European, AIQUY, trades over here on the over-the-counter exchange. So those are the three biggies out there that have exposure, but they're not pure plays. There's a couple tiny ones I talked about. Again, these are nothing here is a buy or sell recommendation, but especially small ones I talk about. I'm just sharing information. Please don't rush out and buy these because they're very small and they're very high risk. Avanti Energy, which is a very small company, and I'll pull up the symbol for you real quick. So Avanti Energy, as you can see here, trades about 98 cents a share. But this is a very small one, about $54 million company. And they're exploring and hoping to produce helium in North America. First helium is even smaller at 29 million. They're looking at Canada to start producing. And then there's a larger one, Desert Mountain Energy. It's about a $176 million company. And they're looking to produce not only helium, but rare earth gases in the U.S. You can see the chart's actually all right, but look how volatile this is, folks. From 375 to $1.25, 350 back down to 250. I mean, you think Bitcoin and cryptos are aggressive and volatile? I mean, look at something like that, extremely volatile and aggressive. So, but I want to share that because I think helium is something where it's overlooked. It's a supply-demand issue, and supply does not seem to be coming online anytime soon here in the near future. And the last one I talk about, and this is one that I've been just started delving into, but I just want to share it, and I'll do a bigger, deeper dive in the future. This is manganese. Manganese is the fourth most widely used metal in the world. It's really been known for its use in steel making. China's a big importer of it because obviously it's a huge steel making country. It's been in hyper growth mode for 2 decades now. So it's been used in steel making. So a lot of times it's moved with the economy because as the economy booms, more building and then more demand for manganese. However, it's now becoming very important in the world of batteries. So this is where I'm seeing this very much come into play, not only in the steelmaking business, but the high purity manganese is used for the EV lithium-ion batteries, and I was blown away to know that 80% of the world's manganese reserves are in South Africa, Ukraine, and Brazil. And then you think about this, Ukraine, obviously we know what's going on there. South Africa's fine, Brazil, not much going on there, but 90% of the battery grade, there's higher grades that are needed for the batteries. 90% of the battery grade manganese produced in China. So again, kind of really looking at China really holding on to it. They account for 74% of all global imports last year. I mean, that's a really high number. But I talked about cobalt earlier, and you're starting to see some of these companies, these battery companies and EV companies, really start to try to get away from your traditional lithium-ion battery. Cobalt's one reason. So manganese is around $4,000 a ton. So it's 20 times cheaper, give or take, from cobalt. So that's one reason. And again, Tesla, Volkswagen, Stellantis, which is the old Chrysler, all looking into this, into using that because it's really going to increase the safety of the battery. It's going to be much cheaper. It increases the output of it really as well. Tesla's working on this new battery. They call it the 4680 cell. And they eliminate cobalt completely. And the manganese part of it increases between 10 and 33%, but it gives the battery 5 to 6 times more capacity and power. And the range increases by 16%. It doesn't sound like a lot, but that's actually quite a bit. And this is, again, why this next number I'm going to show you, that the high purity manganese, again, that's needed for the batteries, the global demand in 2020 was 37,000 tons. By 2030, the end of the roaring 2020s, it's predicted that it will go up to 900,000. That's 38% compound annual growth rate. And there's other firms out there saying it's going to be well over 40%, which would put it above 1 million tons by 2030. So for this to happen, you need to see the production of manganese increase by at least 13 to 18% in the next 8 years. Whew. So what does that tell me? That tells me there's a lot of opportunity out there. So I just started my research, but I'll share a couple of companies out there that I believe you want to put on your watch list. Again, nothing here is a buy or sell recommendation. We are educating you. First one is South32. Again, this is a company that trades overseas. So it trades here as an ADR, and it trades over in Australia is where it's based, and it has exposure operations in Australia, Brazil, and South Africa. Symbols SOUHY. Nice looking chart, folks. If you take a look at it, they produce about 15% of the world's high-grade manganese production. And it's one of the biggest in the world, based in both South Africa and Australia, as I just mentioned. And this company is really setting up to be a big winner as the manganese boom continues. So another one that I wanted to look at is ERMAY. And this company that I've just come across recently, and just in my delving into this. And again, trades overseas, but as I'll show you in a second, it trades here, symbols ERMAY, and they have about 25% of the world's reserves. They also deal in nickel and lithium as well. But manganese makes about 62% of sales, nickel 29%, and the rest, other stuff makes up the rest. A lot of these charts that I've showed you of all three, of lithium, helium, and now of manganese, have this similar chart where they hit highs, they pull back, and are starting the uptrend again. I think most of them will break out to new highs. Again, nothing's buy or sell recommendation, but I think they will be breaking out to new highs. And this is, again, one you want to put on your watch list. So today's show is a little different because I'm more of an innovation guy, but the three things I'm talking about here, everybody thinks I'm tech. Lithium is huge into the future of transportation and future of technology as more things become powered by batteries. Helium, very big into healthcare, future of healthcare. Very big into storage and disk storage, which as we create more data is huge. Very big into quantum computing, the next big breakthrough in computing. So again, part of innovation. And then we move down to manganese, which again, part of batteries for the future, that we will see huge demand coming for people in manganese, and also for steel making. If we have the roaring 2020s, like I believe, we will see more booming economies, and we see more building, which will see more demand for steel, which again equates to more demand for manganese. So you can see how this top-down approach that I take to the market gets down this low to the actual minerals and materials that go into supporting the roaring 2020s. And that's what I love about this trend, the roaring 2020s, because there's so many different angles to play it, and you can build such a diversified portfolio that if you believe in the EV revolution, and you believe in the battery revolution, you got to believe in lithium and manganese. And if you believe in that, but you don't know which company to make, or which battery company, or which car company to buy, or which battery company to buy, you can buy the elements that go into it. And that's a nice way to play it here. So folks, I hope you got educated today. I hope you enjoyed this show. I get excited because every time I do these things, I learn more, and I want to pass on the education of what I'm learning on to you. And again, remember, there's three pillars of this show. We want to educate you, which I think we did today. We want to have fun. I'm not sure how much fun helium is, but hell, I thought it was fun. And then number three, we want to make money. And I think by building these watch lists, by giving you stocks every show to build it, over the long term, you will make a lot of money in the stock market. So again, those are our three pillars we will always stick to, and what this show is built on. But thank you so much for the support. I hope you have a wonderful weekend, long weekend. Don't forget the stock market is closed on Monday. It is Memorial Day weekend. Hope everybody has a wonderful one. Be safe, be happy, enjoy the beach if that's where you end up. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.